Welcome back, everyone. Thank you so much for joining me for this video. Is Japan about to crash global markets? Is Japanese yen carry trade unwind coming? Let's focus on those very important questions in today's video. Experts are hinting at possible currency interventions by the United States and Japanese governments at the moment. There are many speculations now as the yen soared 1.2% against the US dollar overnight on Monday. This followed a sell-off last week, you may recall, which was largely driven by investor fears that the Bank of Japan might intervene to prop up the currency. Here's the shocking statement that was made by the CEO of the very group, Nigel Green. I thought the statement was very, very good. It is brief and it is so on point. Take a look. Japan has been the world's financial shock absorber for a generation, and that role has abruptly ended. It's over, he says. The repricing of Japanese debt is a systemic event, and this is not a local story, and investors need to treat it as such. Last week, I discussed the most recent Japanese government bond sell-off. That video did really well. It has close to 300,000 views by now, and there were many comments and many questions that I wanted to take the time to address in today's video, to dive a bit deeper into this topic. It is a very important one, especially as Japan's elections are just around the corner, February the 8th, and the Bank of Japan is certainly going to move ahead to address a variety of issues that Japan is facing right now. For a very long time, Japanese bond market has been a very stable, quite boring, non-eventful place with Japanese government bonds barely moving and yields actually sitting near zero for a while. Volatility was, of course, virtually non-existent there, and investors treated Japan as a place that you could always rely on for stability and for cheap funding. As the events of the past several months and especially several weeks show us, that's over, that's in the past, and what's replacing that is far more dangerous than most people realize. What we just witnessed in Japan wasn't, of course, a routine bond sell-off. It was a structural shift. In a single session, Japanese bond yields jumped by 1/4 percentage point, a quarter. Typically, if you look at the charts, you will see that a surge of that level takes weeks or even months. The Japanese government bond market is over $7 trillion in size, and it sits at the very center of the global financial system. Now, very quickly, what do I mean by that? Japan exported capital to the rest of the world for decades, literally decades, via Japanese investors buying US treasuries, buying European bonds, emerging market debt, equities, and everything in between. They did this because yields at home in Japan were pinned near zero, and so investing elsewhere, obviously, provided far better returns. This is precisely how Japan became the foundation of the global carry trade, which is based on borrowing cheaply in yen, investing elsewhere abroad, and then happily pocketing the difference. As long as Japanese rates stay low, there's no issue. Borrowing in yen to buy riskier assets works. But if rates keep rising, the trade becomes unstable and very, very dangerous. According to estimates, there is as much as $450 billion tied up in carry trade strategies that impact equities, bonds, and currencies simultaneously. But if you watch my videos, you already know that the days when all of this worked smoothly, those days are over. Why? Well, because the Bank of Japan is changing its policy and PM Takaichi is implementing her vision of what needs to happen in Japan. So that system only works as long as Japanese rates stay low and stable. This is where another important factor comes in: inflation. Core inflation has run above the Bank of Japan's target rate for 4 straight years, 4+ years. The cost of living has been rising. Voters are not happy, they're angry. And of course, politicians are responding the only way that politicians know how, with more spending. But when spending increases, what happens? Borrowing typically increases too. PM Sanae Takaichi has made it very clear that fiscal stimulus is her priority, even though Japan already carries the largest debt burden in the developed world. I believe it stands roughly at 230% of Japan's GDP. So markets actually recognize that contradiction, reality versus the Bank of Japan and PM Takaichi's intended actions. And as I said, more spending means more borrowing. More borrowing means more bonds, right? And more bonds without a central bank standing behind them would yield to higher yields. And so that in turn will encourage investors to take their money and to invest domestically in Japan while selling U.S. treasuries and European bonds and their other foreign holdings. Japan is the biggest holder of U.S. treasuries, so it can get ugly very, very quickly, but at the same time, we should also remember that Japan is effectively a satellite of the United States. It has been since 1945, so politically, PM Takaichi is in a very tough spot. The bad news is that every shock in the Japanese bond market tends to send ripples across the world, and that includes the United States. Goldman estimates that every 10 basis points of Japanese bond stress pushes U.S. yields up by 2 to 3 basis points. So that means Japan's domestic political decisions are now directly tightening financial conditions in the United States, in Britain, and across Europe, whether those countries and governments like it or not. This is why this episode suddenly becomes a major topic of conversation in Davos last week. This is why U.S. Treasury yields sank when Japanese bonds crashed, because everything is interconnected. The yen has become another pressure point. When bond yields spike, the currency volatility typically increases. And so when the yen weakens too fast, Japan is obviously forced to protect it. And the fastest way to do that is by selling foreign reserves, including US treasuries. That is how a Japan problem instantly turns into a US problem or into a European problem by raising borrowing costs. Japanese investors have roughly $5 trillion invested overseas in foreign assets, and on top of that, hundreds of billions more are tied up in carry trades funded by yen borrowing. As Japanese yields rise, the math starts to change. And I briefly alluded to this earlier in this video. Remember, at some point, domestic bonds become attractive again because they are seen as safer and they yield more. One of Japan's largest banks has announced that it plans to aggressively rebuild its government bond portfolio at the expense of foreign assets. Life insurers holding trillions of dollars are openly reconsidering decades-old investment strategies. So it is happening. It is just a matter of time when it unravels fully. For a variety of reasons, including pure politics, it is unlikely that PM Takaichi's government will stand by without doing anything as Japanese investors crush global markets. That's not going to happen, I don't think. But I am skeptical that we will see a big unwind anyway. You might disagree with me, and if you do, let me know in the comments and share your thoughts and the reasons why you feel that way. I would love to hear from you. But even if they take their time selling US or other foreign holdings, it would still impact global liquidity and yields will rise. So all eyes are on Japan and the upcoming snap elections called by PM Takaichi. It will be really interesting to watch what happens next, and if Japan manages to handle this very delicate market situation without effectively the market exploding. So I will keep you updated. Stay tuned. Thank you so much for joining me for this quick episode. Support my work if you haven't already. I appreciate every single one of you who has become a paid subscriber on YouTube, on Substack, and Patreon. Thank you so, so much. I look forward to seeing you tomorrow. Take care.